The ECB just cut interest rates and the markets are reacting accordingly. But the Fed is still holding strong. And as Donald Trump always calls Jerome Powell, he's always late. So is the Fed going to cause a depression because of the lack of cutting interest rates as everybody globally is cutting interest rates? Or is the dollar going to remain strong as everybody else is suffering from massive amounts of inflation, but the Fed and the dollar is not? Well, we'll see. We'll dive into all that. But first, let's start off with the opening here of the ECB now cutting interest rates. The European markets are now edging higher. Wise was up 11% over after earnings. The Eurozone government bonds rallied as regional investors monitored the ECB's decision to cut interest rates by 25 basis points. Now, this marks a lot of different central banks around the world that have cut interest rates in the year 2025. The Fed, on the other hand, has had absolutely zero, zilch, not a single interest rate cut in 2025. Even though Donald Trump is clamoring at the bit, yelling at the top of his lungs at Jerome Powell, cut interest rates, do it faster. But he's always even threatened to fire Jerome Powell, and he hasn't done it just yet. And everybody globally is doing that. In fact, we had Australia talk about a, quote, jumbo rate cut here not too long ago. So it's absolutely ridiculous when we have people around the globe cutting rates and them talking about, hey, we want to have a jumbo rate cut talk. But the ECB is different, right? They only cut by 25 basis points. And that's something that, it's a little cut here or there, but it's still a cut. It's signs that, hey, everybody thinks inflation's over, that everything is all peaches and daisies, and that, we are fine. But the reality of the situation is that Jerome Powell sees what everybody else is seeing. The job market is not super strong. And we've got a lot of other issues globally that I'm going to get into here in a second that are causing these rate cuts to actually be a huge negative for the overall market. Now, bond prices and yields moved in opposite directions, so rising demand can push prices higher and yields lower. The yield on the French 10-year government bond was down by 3 basis points in London, while their Italian counterparts saw yield move 5 basis points lower. Spanish 10-year yields lowered by 5 basis points. Well, it's interesting they mentioned Italy because the Italians here saw the stocks rise after ECB's rate cut. So the Italian stock market hovered around 4,000 or 4,200 on Thursday after ECB cut by 25 basis points to 2%. Its eighth cut in just over a year. So now inflation is now near their 2% target. The question is it really near that 2% target, or are they just saying that? Look, I'm of the opinion that they're just saying that and they're giving all of these numbers. And you guys know I love to show the Govflation website. We'll get into that here in a minute. But let's look at the difference in the comparison of the Fed cutting interest rates. So in the final quarter of 24, we saw the Fed cut 3 rate cuts totaling 1%, bringing the Fed funds rate to 4.25 to 4.5. But this followed a period of high interest rates and higher for longer, as Powell has deemed, by Volcker. So the details of these rate cuts, the Fed initiated the first rate cut in September, then November, then December. So in the year 2025, Jerome Powell has had 0 rate cuts. We've seen rate cuts from the Bank of England. We've seen weakening labor markets. We've seen the dual mandate, the Fed's goal to achieve maximum employment and price stability. The rate cuts were seen as a way to support economic growth. But in reality, we haven't seen the growing economic boom that we once thought we might see. Now, there's plenty of different factors for this. Obviously, many people, the detractors, are going to say, hey, this is because of Donald Trump's tariffs and trade wars. Well, is it? I don't really necessarily think so. I think it's a big cocktail, a mix of all of these different things. right? We had an inflationary and a monetary policy that was shooting up the overall M2 money supply at rapid pace for 4 years. We saw 40% of the money supply printed in a 2-year period. That's plain and simple, full stop. On top of it, we had the overall government shut down and workforce shut down for, 6 months at a time. So when we see things like this, the layover effects of these policies take years, months, and all that to actually show the effects. So what are we seeing now? We're seeing the inflationary effects of policies from previous times, right? So we're seeing the inflationary effects of this now start to come to roost. So the Italian market is now, and all of these other markets, what these markets look at are forward looking, right? They're looking at these things and saying, hey, we're seeing the ECB cut interest rates. It's only a matter of time before the Fed does. And then when the Fed does that, it's all bets are off, all races, right? We're going to see this thing absolutely take off and take off very, very quickly. Now, on top of that, right, we're going to start to see stock markets kind of perform differently, in my opinion, than what we're seeing in everywhere else in the global economies, right? We've always said on this channel that the stock market and the asset market, the asset world, how assets are performing are different than, the overall underlying economy. Wall Street and Main Street, there's been a great divide here for some point in time. And it seems like that divide is going to keep on widening. Now, the Italian stock market, the Italian stallions of the world, are really starting to see this effect come into zone, right? The Eurozone government bonds were rallying while Italian yields were down 5 basis points. The ECB also noted that the potential support for higher public spending. On the domestic front, Italian retail sales rose in April, with food sales up to 1.3% in value and 0.9% in volume on non-food goods also increasing. So that's interesting. They always try to cut out non-food and they always try to cut out energy. But obviously we know that those are two of the most important things. But reality is the ECB cutting rates for the 8th time is widening the gap with the Fed. They say ECB the inflation is slowing in the Eurozone while US tariffs threaten growth. But if you look around, right, Switzerland consumer prices fall for the first time since 2021. So these are signs of a recession that we really haven't seen any other time, right? So we're starting to see that. And then we're also starting to see China manufacturing slow down. And I know that you guys are coming at me and going to be saying, hey, we've seen that China's May manufacturing has shrunk expectedly as tariffs dent sentiment, the worst drop since 2022, right? You guys are going to say, hey, well, obviously the tariffs, when Trump implemented them, the tariffs were really in implementation for like a month or so, right? They weren't like really around for that long, but yet we're blaming all of these things and all of these slowdowns, the worst since 2022. Well, what happened shortly after 2022, right? We had the COVID crash, the cerveza sickness, as my friend George Gammon likes to talk about. We had that happen and the full government shut down. And 2022 was when everything was starting to come about. So the shrinking, the explosion that we saw in early 22, late 21 and early 22 was all because everybody was going back to work. Everything was under wraps. So, maybe with the China manufacturing overgrew in 2022. So the worst dent is, just because of what we saw from the tariffs, right? But the ECB cutting rates is a sign that we should be watching very closely at what central banks around the globe are doing, right? They're looking at these gaps. They're starting to see that, they're cutting these key interest rates, which is at its lowest level since 2023, a response to slowing inflation and threats to the region's growth from Trump's trade war. This was all a part of the plan, folks. They wanted to cut interest rates. Central banks want to keep interest rates low. Why? Well, they could pump their own bags. They could get the investments. They could get inflation. They quote it as growth. But in reality, devaluing your currency and making money somewhat free is not healthy for an economy. I mean, Gutflation has this literally at the top. They have the meme, the money printer GIF just going off here, where he's just cranking that money printer like crazy, right? This GIF is a representation of QE or lowering interest rates, right? Oh, the inflation is at 2.3%. Look, they haven't updated this, but last time when we were at 2.3% or around that, we were at 2.4. Real CPI was still at 10.21%. But the Fed, for some reason, in the next less than 2 weeks, right? It's a 0.9%, less than a 1% chance that the Fed is going to cut interest rate. So you have to ask yourself with this, if the Fed is not going to cut interest rates and ECB, everywhere else is going to do that, why is Jerome Powell holding strong if the economy is allegedly strong, right? I think it's because Jerome Powell sees the reality that all of us see here. The reality is that everything is not strong. Trump is trying to play damage control with these tariffs, right? That's allegedly what he's doing them for. He's saying, we've been taken to the woodshed. Everybody's been ripping the United States off. So now it's our time to fight back and keep on going. Well, Jerome Powell sees the same thing, but they're going at it 2 different ways, right? Jerome Powell sees this. He sees the Dixie at 98. Since I started doing these live streams just 2 months ago, this is the lowest strength we've seen the dollar at. 98.62 or 692, excuse me. So 98.7. We're seeing the strength of the dollar wane at an unprecedented rate. So as we keep seeing this wane, we've got to keep our eye very closely on how the policies are affecting this, right? When Trump was having the tariffs lastly, we saw the Dixie get up to 101. And then everybody was like, cut the rates, lower the tariffs, do all these things. You see in the Dixie just how much that negatively affects the dollar. I mean, the numbers don't lie here, folks. And the market is reacting to forward-looking data. The market is reacting to what we are seeing in the ECB. The market's reacting and saying, hey, look around. We are seeing everybody else cut interest rates, so it's just a matter of time before the Fed does it. Look, I know the Fed is not going to do it in this next one, but maybe the following one. That's the speculation, right? So the speculation with all of these things is, hey, the Fed isn't doing it right here, right now, but maybe in a minute they're going to do that. Maybe soon we're going to see the Fed cut interest rates, right? So we've got to keep a very close eye on what the Fed is doing, the response from Jerome Powell. But it's interesting that at the wake of the ECB cutting interest rates, we see that percent chance of Jerome Powell cutting interest rates go from like 2% to under 1% very, very quickly. 95% of you guys do not subscribe to this channel. So please, please, please subscribe to this channel and smoke the like Cheech and Chong. Tell a friend to tell a friend. I am on a mission to bring you guys all the breaking news and content about what is going on globally in the markets. So please, 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 from the bottom of my heart, hit that subscribe and like button to help me bring this to many more people and help me get to 1,000 subscribers as quickly as possible. I'm hoping to do it by the end of summer. So please, please do that. Thank you so much for tuning in. All 3 of you guys, next time, join in on the chat. I see you guys watching. I appreciate you coming in. But next time, let's get some of those messages popping in the chat.